Good afternoon, students. Today we are going to discuss about hybrid securities with convertible and non-convertible debentures. So before talking to the convertible and non-convertible, what is hybrid securities? A hybrid security is a single financial security that combines two or more different financial instruments. So it is a single financial security which is designed and combined by the two or more different financial instruments. So there are financial instruments, it's combined to become a special single financial security. Okay, it generally combines debt and equity characteristics. Okay, the most common type of hybrid securities is convertible bonds. Of course, there is a plenty, but more number of the corporates are using convertible bonds. And it has a feature, and these conversion or not conversion entirely depends or influenced by the price movements of the bond. Okay, at the same bond, at the same time stock also. Now, this is the introduction. Now we are going to be clear understanding about the hybrid securities. Hybrid securities are bought or sold through the exchange or brokerage. So that means simply selling that buying and selling, which is entirely happening through the exchanges, or sometimes it may be happen through the brokerage firms also. Hybrid securities may give investors a fixed interest or floating interest. So fixed interest or floating interest both will be happen through the two property sides. Okay. At the same time, some hybrid securities holders redeemed at a face value at the time of maturity. Some may be very more than the face value, some may be less than the face value. At the same time, the hybrid security holders has it in tax advantages also. At the same next point, sometimes hybrid securities may be difficulty to sell due to their complexity. So the why it is complexity means there is a more number of disadvantages also, which will be covered in the last of this topic. Okay, so there is a different types of securities used in the corporate world. Of course, in the corporate world there is a n number of securities, but equity securities, debt securities, and derivative securities and hybrid securities. Now we are talking about the hybrid securities. Okay, let's come to the different types of hybrid securities. So there is we already discussed about there is a number of types of securities, but most 5 popular hybrid securities are convertible bonds, preference shares, mezzanine financing, toggle notes, and warrants. So in this as per the syllabus of our topic of the our course, we are going to be discussing about convertible bonds and non-convertible bonds. So here we had mentioned that convertible debentures, convertible bonds. Okay, so let's come to the difference between the bonds and debentures. Differences. So simple definition, bonds are backed by the assets of the issuer, whereas debentures are not secured by any of the physical assets. So if there is a guarantee, bonds will be released. If there is no guarantee by the issuer, then the debentures will become. Okay, but coming to the both are, debentures will charge more number of the interest, that means the returns. Okay, that is a simple difference. So most number of the time bonds and debentures will treated here as the same. Okay, let's come to the convertible bonds. So convertible bonds, it is a type of security that gives the investor a bond along with the power to convert that into the stocks. Okay, so the same company, the company is the same, the bond come from the same company, even stock come from the same company, both are going to be a same company. So the investor has to decide whether he convert this bond into the stock or not. It depends upon the plenty factors. Okay, so now before the conversion it is a bond, but after the conversion the bond may become a stock. Okay, to do this conversion, investor used conversion formula. This conversion formula is a predetermined, that means pre-decided and pre-accepted between the issuer and the investor. Okay, so this pre-decided or determined is a formula based. This formula we call them as a conversion ratio. What is the meaning of ratio? Okay, so let's see here. So how many shares would a person get to the if he converts the bond into the stock? So how many shares are there, how many bonds are there, how many bonds will be converted into the shares, or how many what is the ratios which will be decided in the predetermined area. At the same time, next point, so investor only converts their bond depends on conversion price. So we will discuss this point is very brief because it is very important. Conversion price. See here, just example. Suppose think like an investor. Think like a investor. Okay, so a investor has a suppose one bond. Its price is, suppose the price is 500 rupees. Suppose this investor is thinking that whether he convert this bond into the share or not. Present this same company share trading in the market 600 rupees. So at the time of maturity, at the time of desire of the investor, whether he convert or not depends upon the market price of the share. So if he at the time of maturity, if the investor wants to mature, that means redeem this bond, he will definitely receive 500 rupees. Of course, 500 rupees other than if it is changing in the market price of 550 rupees. So of course in this area it is 50 rupees is benefitable to the investor. So this is one more of option to the investor. Suppose he has to go for the another option. So this bond is going to be converted into the share. In this share is going to be returning to the investor is 600 rupees. So when compared to the 50 rupees of a profit, he is going to be benefit of 100 rupees because after the conversion the share will be sold in the open market for 600 rupees. Okay, so the investor is going to be taking off 100 rupees benefitable. If you come out with the net profit, so 100 minus 50 is equal 50 rupees is more benefitable due to the conversion of the bond into the share. Okay, this is the benefitable. That's why we are coming here. The investor only converts their bond depends upon the conversion price. So if the price is more or less, which will be decided by the investor, then he will take the decision. This is the introduction regarding the convertible bonds. Now we are talking about the non-convertible bond and debentures. So non-convertible, so the debenture which cannot be converted into the shares are called as NCDs, that means non-convertible debentures. So it cannot be converted at all, whether it may be matured or not matured, whether it is accepted or not accepted by the investor, it definitely will not be convertible. So in this NCDs are acting as a tool. Why it is acting as a tool? Because it is acting as a tool for the investors, as well as the company people also, that means organization. It's a long-term fund is providing to the company. So the next one, when compared to the convertible bonds, non-convertible bonds provide the higher rate of return. So that is the one more benefit is to the investors. Now we are talking about one more point. Even non-convertible debentures offers various other benefits also. The first benefit, high liquidity. Why? Because this hybrid securities of non-convertible bonds listed in the stock market also. So if it is a stock market listing, there is a market, that means the secondary market also. The next one, the tax exemptions. Some NCDs has also the tax exemption, that is a benefit to the investors. Now I am talking about by companies which have a good credit rating, automatically it has a more demanded in the marketplace. So the high liquidity, tax and good credit rating, which are all going to be benefitable to the NCDs. Okay, the next one, in India generally have a minimum maturity period of 90 days. Okay, so now we are talking about the advantages and the disadvantages of hybrid securities. The first one we call them as a advantageous point of view. We call them a higher yield. Yes, it is a more higher yield when compared to the convertible, non-convertible. Okay, the next one, less volatility. Of course, the volatility means the fluctuations of the market prices, market interest. When compared to the debt market or equity market, hybrid securities are less volatile because it is going to be depends upon two markets. Okay, so the next one, diverse nature. It's a diverse nature means it is the risk profile is very low when compared to the individual property. So why? Because if there is a risk which is going to be substituted one instead of another one. Okay, so debt to share, so it is going to be substituting each one. Okay, so the next one, disadvantages also. The point number one, complicated. So the investor has to concentrate about the debt market and the share market at a time. then only he will be manage the hybrid securities in the convertible and non-convertible segment. The next one, it has going to be risk. Yes, hybrid securities has the risk. Of course, risk is very common for everywhere, but even the risk also included in the hybrid securities. Okay, so in that type of risks are credit risk, liquid risk, extension risk, capital trigger risk, and non-viability risk. These are all are different types of risk for the hybrid securities. Okay, so I hope you understand well about this hybrid securities. Thank you.